Hello all. So today we are going to discuss with examples and case studies which may come in IBBI exam based on theory concepts which we discussed in last session, which was on principles of insurance and loss assessment. Case study up to 12 marks may come out of today's session. So let's start. So this is the IBBI exam syllabus on this topic of principle of insurance and loss assessment. Theory up to 3 marks can come out of it, and numerical up to normally not more than 12 marks, but it may come up to 20 marks also out of this chapter. From examination perspective, there are few important points which we should remember to ensure 100% marks in the numerical or case study if it comes in the IBBI exam. So first concept is under insurance quotient. Theory part we have already covered in last session. If you have not gone through that video, please go through that video first and then you start example and case study in current session. So it is equal to sum insured at the time of policy purchase. So when we purchase the policy, at that time whatever is sum we had insured divided by value of asset on the date of claim. So it is not value of asset on the date of policy purchase, rather it is on date of claim. So it is important point we have to remember. So sum insured at the time of purchase of the policy, but value of asset is being taken on the date of claim. So claim payable is equal to value assessed as loss into multiply by under insurance quotient. So these are the two important formulas. Next important factor which may be required to understand, and we have already discussed theory part in last session, is policy excess. It is the amount that you have to pay from your own pocket and the remainder is paid by the insurance company. So for example, if cost of repairing a damage is rupees 4,000 say, and the insurance policy has an excess clause of say rupees 600, then you have to pay 600 rupees from your own pocket, and then balance 3,400 shall be paid by the insurance company. It is like file charge. In case of motor insurance, normally a file charge or a policy excess of 1,000 rupees is being paid by the policy holder. Broadly, there are two types of policy excess. First type of policy excess is standard excess and second is voluntary excess. So what is standard excess? These apply to every claim. For example, car insurance policy normally have a standard excess clause of 1,000 rupees as file charges. So as a policy holder, I don't have a choice to increase or decrease it, but this will apply as a part of process, as a policy of the company or some statute. So there is some other voluntary excess also. So if it is chosen by the client to reduce the policy premium, so as in case of car, then 1,000 rupees is a normal file charges or policy excess. However, if I want to pay up to 5,000 rupees of claim amount from my own pocket, so I can increase it up to 5,000, 10,000, 15,000 maybe. So basically it is being taken to reduce the policy premium, right? So if voluntary excess has been taken by the customer, by the policy holder, then this nominated excess will replace your standard excess. So if in case of car insurance I go for a voluntary excess of say 5,000 rupees, then that 1,000 rupees will not be exist of standard charges, file charge will get replaced with the 5,000. So in case of any claim up to 5,000 rupees, I will pay from my own pocket. Next important concept from example and case study purpose is insurable value. It is the replacement cost or actual cash value of a building for which standard insurance policies provide indemnity cover. So insurable value is less than the property's appraised value or market value because it excludes land and other certain items like foundation cost, underground piping, wiring, etc. So market value is different, but insurance value is different. Insurable value is different. So normally it is less than the market value. The exact formula for computing insurable value is usually given in the valuation clause of the policy document. So from practical aspect, if we are getting assignment from market to calculate insurable value, so we should always go through the policy document to find print of the policy, to calculate the actual insurable value. However, in case of from IBBI exam perspective, either these assumptions will be given, or if not given, then whatever things we are going to discuss in our upcoming sessions, in upcoming slides, so those things we have to deduct from the total value of the property to arrive at the insurable value. Let us see. So insurable value is equal to cost minus land value. So land is not required to be insured, minus foundation cost, then underground wiring and piping, any other item mentioned for exclusion in policy. So primarily, broadly, whatever expenses we incur till plinth level. So underground wiring, piping, whatever expense for foundation cost. So up to plinth, normally whatever expense we incur, so those expense plus land value is excluded from the insurable value, because insurance policy doesn't cover normally all these aspects. Another concept of salvage is salvage value from insurance value of the property perspective. In case of insurable value, salvage value is normally considered to be nil unless specifically mentioned in the question. So please be very careful. If it is mentioned in the question to consider some salvage, if it is silent, then always presume zero salvage. So example number 1, the property specified below is to be insured against fire. Calculate insurable value of the property. So data given in this question is that plinth area of the timber frame structure is 1000 square meter, age of the building is 20 years, future life of the building is 35 years, estimated cost of construction of a similar new structure is 10,500 rupees per square meter. It is nothing but replacement rate. Depreciation is given 30% and assume cost of foundation as 15%. So first we have to calculate replacement cost of the building, which is equal to, replacement cost is equal to area, which is 1000 square meter, plus replacement rate into multiply by replacement rate, which is 10,500 rupees per square meter. That means 105 lakh rupees is the replacement cost of the new building, replacement cost new of the full building including foundation. So now to arrive at insurable value, first we have to deduct foundation cost from the replacement cost, which is equal to replacement cost as calculated from here 105 minus foundation cost. Foundation cost is given 15% of the building. So since total cost is 105 lakh, so foundation cost will be equal to 15% of 105 lakh. So if we deduct this 15% foundation cost from the 105 total building, then we will get total building cost excluding foundation will be equal to 89.25 lakh. So now we have to reduce depreciation also, because there is no mention of reinstatement clause in this case, so we have to deduct depreciation also. This concept we discussed in previous session, last session also. We'll see application of reinstatement clause in upcoming case studies. So then we have to reduce depreciation from the building RCN of the full building excluding foundation, which is equal to 89.25 lakhs. So depreciation is 30% of the building cost. So 30% of 89.25 we will deduct, which is equal to 26.77. So 89.25 minus 26.77 is equal to 62.47 lakhs. So this is the answer. So this is the insurable value of the property as of now, as on date. So case study up to 10 marks may come. A standard fire policy is there for 50 lakh rupees of factory building and measuring 700 square meter of 20 years old building. So replacement rate is given 20,000 rupees per square meter. Fire loss is 10 lakh rupees. Life is 60 years and salvage is nil. Even if it is not mentioned in the question, we have to presume salvage is nil. Calculate 5 things we have to calculate. Claim payable. Claim payable if excess clause of rupees 10,000 is mentioned in the policy. Present market worth less foundation before fire damage. Replacement cost of building new today deducting 10% for foundation. and depreciation of building excluding foundation considering SLM method. So I always say first you write down the data, whether it is relevant for the question or not, and try to group the data into various groups, small groups. So here data given is sum insured 50 lakh rupees, fire loss is 10 lakh rupees, building area given in the question is 700 square meter, age of the building is given 20 years, replacement rate is given 20,000 rupees per square meter, total life of the building given in the question is 60 years, salvage given is nil, 0%, foundation cost given in the question is 10%, and method to be used for depreciation is SLM. So first we have to calculate replacement cost of the building and depreciated replacement cost of the building as on day of damage. So replacement cost is equal to area, replacement cost new or replacement cost of the building is area of the building, which is 700 square meter and given in the question, and replacement rate, which is 20,000 rupees per square meter, which is also given in the question. So total replacement cost new of full building is 140 lakhs. Now we have to calculate percentage depreciation, depreciation amount and depreciated amount. So this concept we have discussed, difference between depreciation and depreciated amount. This important concept we have already discussed in previous sessions. So percentage depreciation as per SLM method is equal to age of the building, which is given in the question 20 years, divided by life of the building. It is also given in the question 60 years. So 33.33% is the percentage depreciation considering the present age of the building. So depreciation amount is equal to 33.33% of RCN of the full building, replacement cost new of the full building, which is calculated as 140 lakh above. So it is, so total depreciation amount is equal to 46.67 lakh. So depreciated amount of the building, full building we are talking here, is equal to RCN of the full building minus depreciation amount calculated here. So it is equal to 46.67 lakh. So total depreciated amount of the building, of the full building, is equal to 93.33 lakh. Now calculate insurable value, which is equal to, that is value of asset as on date of claim. Insurable value is value of asset as on date of claim, and it is equal to depreciated value of the building calculated in last slide here, full building, less foundation cost, which is given as 10% of the replacement RCN of the full building. So that means 93.33 lakhs is the total cost, total value of the building, full building, depreciated value of the full building. So 10% of 93.33 will be deducted from the total value. It will give us the insurable value of 84 lakhs. So that means under insurance quotient is equal to sum insured divided by value of asset as on date of claim. So sum insured was 50 lakh rupees as given in the question, and insurable value as on date of claim is 84 lakh rupees. So under insurance quotient is equal to 59.50% or 0.595. So claim payable is equal to, formula we already discussed in last slide, previous slides, fire loss, which is 10 lakh rupees, multiply by under insurance quotient. So claim payable will be equal to 5.95 lakhs. So this is answer to question number 1, and question number 3 answer we have calculated above. So claim payable with, if we consider excess policy excess of 10,000 rupees. So if we, that means 10,000 rupees we have to pay from our own pocket. So remaining about 10,000 rupees will be paid by the insurance company, and then claim payable will get reduced from 5.95 lakh to 5.85 lakh. So 10,000 we have to deduct from 5.95, that is 5.85 lakh will be paid by the company if there is a provision or clause of 10,000 rupees of policy excess in the insurance policy. Replacement cost new of the building, deducting foundation. So basically replacement cost of full building as we calculated in previous slides was 140 lakhs. So since 10% is the foundation cost, so that will deduct from the total complete building, so which is equal to 126 lakh is the replacement cost of new building deducting foundation cost, and this is the answer question to answer number 5. And depreciation amount of building excluding foundation. So it is equal to percentage depreciation for 20 years, which is age of the building, existing age of the building as given in the question, and RCN of the building excluding foundation. So since depreciation amount of building excluding foundation is required, so RCN of building excluding foundation is equal to 126 lakh as calculated here. So 33.33% of 126 lakh is 42 lakhs. So this is answer to question number 5. Next case study of 12 marks. A standard fire policy was taken for 161 lakh for a factory building with RCC roof. 1400 square meter is the area and age of the building is 15 years. So replacement rate given in the question is 1800 per square meter. Fire loss given in the question is 30 lakh rupees. Assume life of the building 60 years and salvage value is nil is given in the question, and then we have to calculate these 6 questions. We have to find answer to 6 questions. Claim payable if there is no policy excess. Claim payable if policy excess of 10,000 rupees is there. Present worth excluding foundation before fire damage. So what is the worth of the building excluding foundation cost just before fire damage. So replacement cost of the new building deducting 15% for foundation. Depreciation of the building excluding foundation on SLM, and percentage depreciation if salvage value is 20%. So here explicitly salvage value is given. So for first 5 questions we will assume 0 salvage, and for 6 questions we have to assume 20% of salvage value. So first write down the data given in the question and try to bifurcate the data into two groups, building data and policy data for convenience purpose. So building data given in the question is that building area 1400 square meter, building age 15 years, replacement rate 1800 rupees per square meter, building life 60 years, foundation cost 15% of building cost, salvage nil for question number 1 to 5 and 20% for question number 6. And policy data given in the question is that sum insured is given 161 lakh rupees, fire loss is given 30 lakh rupees, policy excess 10,000 rupees for question number 2, and then depreciation method given in the question is SLM. So as usual, first of all we have to calculate replacement cost of the full building, then we will calculate foundation cost, and then we will calculate the RCN of the building excluding foundation. So replacement cost of full building is equal to building area given in the question multiplied by replacement rate. So both things are given. So that means 1400 square meter multiplied by 18,000 rupees per square meter is equal to 252 lakh rupees is the replacement cost of full building, RCN of full building. Now foundation cost of new building. So it is also given in the question is equal to 15% of the RCN of full building. So that means 0.15 multiplied by 252 lakh. So that is 37.80 lakh is the foundation cost of the new building. Then that means RCN of building excluding foundation. So if we deduct foundation cost from the full building, then we will get RCN replacement cost new of the full building excluding foundation cost is equal to RCN of full building minus foundation cost. It is equal to 252 lakhs minus 37.80 lakh calculated above is equal to 1214.20 lakh is the RCN of building excluding foundation. So this is answer to question number 4 given in the question. Since salvage value is nil, so percentage depreciation using SLM will be is equal to age of the building divided by life of the building is equal to 15 years is given as a age and total life is 60 years. So that means depreciation for 15 years, which is present life of the present age of the building, is 25%. So depreciation of building excluding foundation. So percentage depreciation calculated above 25%. Here we calculated. Multiply by RCN of building excluding foundation as calculated in last slide. It is equal to 214.20. So 25% of 214.20 is equal to 53.55 lakh is the answer to question number 5. This is the depreciation on the building excluding foundation. So insurable value of building before fire damage, it is equal to RCN of the building excluding foundation minus depreciation amount excluding foundation. So RCN of the building excluding foundation we have calculated here in the last slide, and depreciation amount excluding foundation we have calculated above here. So total value is 214.20, which is RCN replacement cost new of the building excluding foundation, and 53.55 is depreciation. So we will get the answer of insurable value is equal to 160.65 lakh, which is answer to question number 3. So next we have to calculate under insurance quotient to arrive at claim payable. So under insurance quotient is equal to sum insured, which is given 161 lakh rupees as data given in the question, and insurable value of the building just before damage, which is we have calculated here, and is equal to 160.65. So here sum insured is more than insurable value of the building. So this figure is coming more than 100%. So under insurance quotient can never be more than 100%. Please remember, if it is more than 100%, so we have to give answer to, we have to click tick answer on 100%. So it is an important aspect. Examiner may confuse you on these points. Please remember, if the value of this under insurance quotient is coming more than 1 or 100%, so we have to consider 100% always. So claim payable is equal to fire loss given in the question multiplied by under insurance quotient, which we calculated in last slide, is equal to 100%. Cannot be more than the sum insured. Insurance company will not pay you anything more than the sum insured under any circumstance. That is one of the principles of insurance we discussed in the last session. So it is equal to 30 lakh rupees. So claim payable if the policy is having policy excess of clause of say 10,000 rupees. So 10,000 rupees as a proposer, I have to pay from my own pocket, and remaining 29.90 lakh will be paid by the insurance company. And this is answer to question number 2. Percentage depreciation if salvage is 20%. So up to 1 to 5 question we assumed salvage nil, but however in question number 6 the assumption given is that the salvage will be 20%. So percentage depreciation will be equal to 100% minus salvage multiplied by age and divided by total life. So salvage is 20%, so age is 15 years, life is 60 years. So percentage depreciation, if we assume salvage is 20%, is equal to 20%. It is answer to question number 6. Next case study of 4 marks. A standard fire policy with reinstatement clause. So here we'll try to understand the concept of reinstatement and application of this concept or principle. Was taken for 161 lakh rupees for a factory building of 1,400 square meter of 15 years old. Replacement rate is 18,000 rupees per square meter. Fire loss is 30 lakh. Assumed life 30 years. Salvage nil. Plinth foundation 15%. Calculate claim payable. Can claim payable if policy excess is 10,000 rupees. So data is similar to the last case study, more or less. But only difference here is that the policy is having additional clause for reinstatement. So reinstatement clause is there. Let us see how this clause will impact on total insurance value, insurable value, and claim payable of the property. So building data given in the question, it is almost same as given in the last question. Only addition is that here reinstatement clause is given. So first, like in last case study, we have to calculate replacement cost of the full building, which is building area multiply replacement rate as given in the question. So 252 lakh rupees. Then like in last case study, foundation cost of the building is 15% of the replacement cost of the full building is given in the question. So 15% of 252 lakh is equal to 37.80 lakh. If we deduct foundation cost from the full building, then we will get replacement cost new of the building excluding foundation. It is equal to 252 lakhs minus 37.80. So that means 214.20 lakh is the value of the new building. Replacement cost new of the full building excluding foundation cost. So since there is a reinstatement clause in the policy, there will not be any effect of depreciation on property value before damage. So it is like zero dep policy as in case of car insurance. So under insurance quotient is equal to sum insured divided by insurable value of the building before damage. So in previous case study we deducted depreciation cost from this 214.20. However, here in this case depreciation is not deducted. So this because of this, sum insured is given is same 161 lakh. However, total value of the building without depreciation just before fire claim damage has increased from 160 as in last case to 214.20 lakh. Right. So that is why sum insured under insurance quotient has been reduced from 100.22% in last case study to 75.16% in this case, just because of introduction of reinstatement clause in this question. So that means claim payable here is equal to the fire loss into under insurance quotient. So in previous case there was no reinstatement clause, and because of that we were able to get 100% of the fire claim. However, in this case, because of introduction of reinstatement clause, we are getting only 22.50 lakh of claim. amount, and it is answer to question number 1. So, and claim payable, if excess of 10,000 rupees is there, then 10,000 we have to pay from our own pocket. So that means claim payable will be equal to 22.54 lakhs minus 0.10 lakh or 10,000 rupees. It is equal to 22.44 lakhs. So it is very important to get right sum insured. So had this policy owner taken paid premium for insurable value up to 2.14.20 lakhs or 2.15 lakh rupees, he would have got full claim. So this is very important. This shows the importance of calculation, why it is important to calculate near accurate insurable value of the property. Another case study: when factory got damaged, the sum insured is 50 lakh rupees. Claim made by the owner is 10 lakh rupees. The property is 20 years old. Present replacement rate of a similar new building is 7,000 rupees per square meter. Built up area is equal to 2,000 square feet. Life of building is 40 years. Calculate replacement value of the building. Claim amount to be approved by insurance company. So first write down the data and try to bifurcate the data into two segments, two groups: building data and policy data, as discussed in last previous questions also. So building age is given in the question is equal to 20 years. Replacement rate is again given, which is equal to 7,000 per square meter. Built up area here is given as 2,000 square feet. So it is important. Sometimes examiner may give you certain data in some other units also. So if it is given in square feet, all other data is given in square meters. However, this built up area is given as square feet, just to confuse the aspirants. So we have to convert this 2,000 square feet into square meter, which is equal to 185.87 square meter. Total building life of the building is given 40 years. Since detail about salvage and foundation cost are not given, we shall assume nil value. It is also important. So if the question is silent on these two things, then please assume foundation cost also equal to nil. So salvage and foundation is equal to nil. Policy data given in the question is sum insured is 50 lakh rupees and claim made by the owner is 10 lakh rupees. So here replacement cost of the full building is equal to building area given in the question, and it was given 2,000 square feet, but we had calculated, we have converted that square feet into square meter, which is equal to 185.87 square meter multiplied by 7,000 per square meter is replacement rate given in the question. So that means replacement cost of the full building is equal to 13.01 lakh. Foundation cost is given nil in the question. It is not given, so we have presumed it nil. Percentage depreciation using SLM is equal to age divided by life. Since salvage is 0, so it is equal to 50%. So depreciation amount is equal to percentage depreciation 50% of the replacement cost of the full building. So it is 13.01 lakh, which is equal to 6.505 lakh. Insurable value of the full property before damage is equal to RCN, replacement cost new of the full building, less depreciation amount, less foundation cost. So replacement cost new of the full building calculated in the last slide is equal to 13.01 lakh. Depreciation amount is 6.505 lakh, and foundation cost is presumed in this question is nil. So total insurable value of the property just before damage is equal to 6.505 lakh. Since sum insured is more than property value, sum insured is equal to 50 lakh rupees, and it is much more than the property value, which is 6.505 lakh. There will not be any under insurance quotient, so it will be 100%. Company will pay 100% of the claim payable. The client will get full amount equal to depreciated value of the property before damage against claim of 10 lakh rupees. So it is not like I have taken sum insured of 50 lakh rupees, so I will get any amount up to 50 lakh rupees. So it cannot be more than the actual loss, actual value of the property just before damage or claim. So since value of the property is 6.505 lakh, so maximum claim which can be allowed is 6.505 lakh as against claim amount of 10 lakh rupees. If policy is made only for superstructure assuming 15% of cost, then claim payable will be equal to 85%. So if foundation cost is given as 15%, so we will deduct that value from the RCN of the building from here, and then 80% of the depreciated RCN value will be answer to that question. So that's all in today's session. Thank you very much for watching the video. So before I'll tell you what we are going to have in our next session or next series of sessions, so I would request you to please subscribe to the channel and click on bell icon so that you will be notified immediately as soon as I upload the next video. So next session, in fact a series of sessions, we are going to have a discussion on various concepts and theories on environmental issues in valuation. We will also see examples and case study. Straightforward 3 marks theory is very easy to understand, very easy to grab. So, and numerical may also come to 12 marks or maybe to 15 marks also from this session. So keep watching. Thank you.